Hello, everyone, and welcome to the episode number 9 of JustDario Cigar Time. So today, the topic of the podcast, after many requests that I received, is going to be my personal rules for value investing. So this is a very interesting topic to talk about nowadays. Why? Because pretty much everyone, especially on social media, completely forgot about value investing. And on mainstream media, we even have article claiming that value investing is dead. It's a thing of the past. There are new metrics to consider. The boom and bust cycle is not there anymore, and any other sort of garbage. Why garbage? Because value investing is, of course, not dead. But truth is, in the current time, so many things out there are completely overvalued. Some of them to an extreme that not even at the heights of the dot-com bubble have been experienced. So before going to my 5 rules about value investing, that of course, I'm not going to repeat what you can find in the famous book of Benjamin Graham, in the letter of Warren Buffett, and all these kind of things. Of course, these are my personal 5 rules that I added on top of those, and frankly, adapted to the changing of time, because through that time change and the world goes on, I need to be open-minded about the environment, not to miss incredibly valuable opportunity that will eventually translate into very high personal gains. So before starting to talk about my personal 5 rules, I would like to spend a few minutes on one fundamental rule that I always apply to everything, okay? This rule is don't fall into confirmation bias. So what is confirmation bias? Confirmation bias is simply that attitude to look for elements that reinforce your conviction and your thesis about something. So why confirmation bias is incredibly dangerous? It's incredibly dangerous because due to that, more often than not, you tend to overlook all those very important elements that might actually be significant in taking a true informed decision. And 9 times out of 10, those elements tend to go against your thesis. So because of that, one very simple thing I do all the time, and frankly speaking, even after I place an investment, I continue to apply that. I never look at charts. Oh my God, why I never look at charts? Okay, this might sound crazy since nowadays, like all that people do, like on social media and whatever, is posting charts, trends, patterns, and whatever sort of thing out there. So why I don't look at chart? Because basically in a chart, more often than not, people see what they want to see. And that is actually increasing the chances to fall into confirmation bias rather than making a real objective judgment about an investment opportunity. Don't take me wrong, charts can be very useful. In particular, like if you compare prices with volumes, okay, if there are on any gaps, if there are any abnormal trends, if there are any diversions from long-term average and so on. Those are elements that can be very useful. However, starting to look into an investment because of that and managing your investment starting from those, it ends up being misleading. And let me make a very simple example here. most of the times you see people like posting upward trend charts, and if you check their conclusions, again, 9 times out of 10, that's bullish. Okay, why? Just because it goes up. Same if it goes down. Okay, what about momentum, trends, and this kind of things? Same stuff. The thing that, personally speaking, I never really believed much into. There might be some value into that for some, but personally not for me. Is people that, design waves, shoulders, head, and whatever. There might be some truth into that, because in those patterns, there is actually a reflection of a psychological behavior of a very short-term investors. Furthermore, if everyone believes into something, there is a self-fulfilling theory that it might happen. So there is some truth into that. But when you talk about value investing, you're not talking about trading. When you call yourself an investor, you're not buying a share or a token or a quota of a private company in order to sell it in a day, in a week, or in a month. Value investing is investing in a project for the medium to long term. Years can be needed to see the true value of a company coming up and the price tagging along. So this is my fundamental rule. Never fall into confirmation bias. Because, by definition, if you're already looking into a company, there is already a seed in your mind that you're interested in the company, you want to buy it. So if you fall into confirmation bias, you might end up reinforcing this wheel and overlooking that many elements that will undermine your objective assessment. Okay, after saying this, let's move on to my 5 rules. Rule number 1, cash flows. So never forget 2 things. Cash is king, no matter what. And if a business doesn't make money, it doesn't make sense. Very, very simple. I'm not talking about net income, revenues, and stuff like that. Let me be clear. Nowadays, it's so popular to use like non-GAAP, that stands for General Accepted Accounting Principle measure, in order to record revenues, costs, and whatever. But one thing that can never lie is the cash, okay? To a certain extent, there are ways to manipulate it, of course, but maybe this is too much of an advanced topic for today's, although it's quite difficult to manipulate cash and to manipulate the cash flow. Although cash flow can be used to manipulate the extent of revenues, costs, and whatnot, distribution, okay? So cash is king. Now, here we need to make a distinction between young companies and startup and mature companies. For young companies and startup, my rule is very simple. Does this company have enough cash to reach break-even? Yes or no? If the answer is no, forget about it. The business is not sustainable. If the answer is yes, then it looks good. Okay? Should go to the next rule. And remember, for young companies, they always have costs. So for them, reaching break-even is not just like, a word that everyone uses. It's actually the ability to sell the product or services that they're building. And forget about the spreadsheet projections or whatever. Show me your sales. Show me your clients. Is cash coming in? Yes or no? So if the cash doesn't come in, that's a problem. If the cash doesn't come in as much as your expenses, that's another problem. And I tell you, like, these companies can easily become money pits. So be very careful about their ability to reach break-even. For mature companies, the assessment is a little bit more complicated. The first thing I look at is the cash flow growth. How much they can grow their free cash flow quarter by quarter, okay? the free cash flow is very fundamental for every type of company because effectively the cash that is available to the management of the company to be eventually reinvested into the company and to create more value for the company itself. Okay. So if the free cash flow is negative, if the free cash flow is decreasing, it's a bad sign. If the free cash flow is stable, maybe this company, reached a plateau. Okay. So that's a very important item. And as I anticipated, one element that I always look at is how much of this free cash flow is reinvested into R&D. So research and development is incredibly important, okay? So why it is incredibly important? Because that's where the value comes from. I mean, let's make extreme example here, okay? If you have a company that makes only one widget, okay, and then this widget reaches 100% of the market, okay, are you going to be willing to invest into this company? Yes or no? It depends. It depends on the yield that you can achieve. But effectively, companies of this sort become like bonds, to a matter of fact, right? And since they become like bonds, the equation is very simple. How much cash I invest and how much return I want. If there is someone else that is willing to have a lower return than myself, it will pay a higher price. But that doesn't mean that the value of my investment is going to increase, right? It's simply a willingness of someone to accept a lower return for something that I hold, okay? So if a company doesn't invest in R&D or invest very little in R&D, that's a bad sign. But doesn't stop there. You need to be wise and calculate what is the return of investment on that R&D. Why? Because the truth is that there are so many companies out there, and I'm talking about very large mega cap trillion companies. Yes, they have R&D investments, right? But what is the return on investment of that R&D? Well, the truth is not that much. They keep making money on their legacy products, and for most of them, the revenues increase just in line with inflation, because that's the truth. And whatever they spend in R&D, most of the times it ends up being like some marketing gimmick, like products that honestly no one wants, like updates on existing products that add no value. They simply maintain the product at the status quo, and they avoid this product to become obsolete. But that is not even an R&D. It's actually a misrepresentation. So the return of investment on R&D is incredibly important. If you consider this parameter, wow, so many companies out there will fall off the sky, but somehow no one cares anymore. And then to conclude on this section, how much cash is invested by the company? Pay attention here, because this is a very important topic. When you buy a company, you're buying a share of the business, right? Future returns on the product, on the service, or whatever. For whatever reason nowadays, there are these companies accumulating larger and larger and larger investment portfolio. Tell me one thing. What is the purpose of a company to have a $10 billion portfolio distributed between U.S. Treasuries, other corporate bonds, commercial real estate, MBS, whatever? What's the purpose? Like, they're making a widget, doing a service. If I want to be invested in U.S. Treasuries, in corporate bonds or MBS, I'd rather do it myself, right? So all these companies piling up investment portfolio is actually a very bad sign. Why? Because they don't know what to do with that cash. They should be distributing that cash to their shareholder and give them the choice to reinvest in the company shares, to buy something else to measure the portfolio. But for them to build this large investment portfolio, that's not what they're supposed to do. There are investment companies for that. There are funds for that. That's a whole different story. So a company that grows this large portfolio usually is a rather bad sign. And more often than not, these companies, they end up doing investments, M&A and sort of things that in the majority of the case end up quite poorly, okay? The pitch is always the same. Okay, we have all this extra cash, we buy another company, and this will add growth to us, okay? But if you buy the other company, it means that someone is willing to sell it to you. And if someone is willing to sell it to you, there are two situations. Either they know the business is going to go crap, or you are giving them an offer that is hard to refuse, right? What's the common denominator between this? The common denominator between this is that you end up overpaying. So every time they say, oh, we buy this company, there's going to be synergies and whatever. What kind of synergies? You fire a couple of hundred people in administration? What kind of synergies are you looking to? So the real synergies that make sense they tend to be mergers of equals, right? Two car companies that are doing pretty bad, sales are shrinking, and they're using their factories at 30% capacity. They can merge, shut half of the factory, and use the remaining factories at 80% capacity. And that will actually create value for their shareholders out of efficiency, limited overheads and stuff like that. But if you have a company that has cash and starts shopping around, it doesn't really create synergies, doesn't really create value. So what's the point, right? And the most interesting things nowadays is this shopping spree of startups. Oh, a startup is an interesting idea. 1 billion here, 1 billion there. And hold on a second, did you look into the numbers of this startup? All these startups, most of the times they don't even have a product yet. And what these startups end up doing, they simply end up being clients of suppliers of the very same company that purchased them. But hold on a second. So you bought them. So as I say, you ended up overpaying, otherwise they wouldn't sell it to you. And those that are selling it to you, the founders, it's not a very good sign. It means that they don't really believe much on the product, because if they did, they could make way much more money remaining invested, right? So this concludes these points, but be very careful about where is the cash, how the cash is generated, and how it is deployed. Rule number 2 is leverage and debt cycle. So nowadays, borrowing money, in particular for established companies, is so freaking easy. The yields are freaking stupid. There is so much liquidity out there and so much willing lenders that they can cherry pick. But here the question is very simple. Is this debt sustainable or not? Okay. And here is the rule of thumb. If a company cannot afford to stop rolling its debt and repay its debt with the cash generated by the business, sorry, but that's very poor value there. Quite poor value. Rule number 3, founders and top management commitment. Okay. So this is an element I already hinted a few times in the previous points. Okay. So remember one thing. No one sells out something for a value below what they think they can earn, right? No one likes to fire sell thing or whatever. So if a founder isn't committed in his project, if it is trying to cash out or any sort of stuff, okay, lead a fundraise, and then as part of this fundraise, himself and a bunch of very selected internal employee of the core team can sell shares and things like that is included. Yeah, it's a bit of a bad sign. If the top management continues to sell their shares, people will say, come on, but they need to cash out something and whatever. Again, Do you think they will do that if they believe there is more upside into it? No one likes to pay taxes, so why to cash out, right? And in particular, the key behavior is more than selling, is the buying. So right now, we are at all-time high of insider sales. These people are selling as if there is no tomorrow. Why? Our market supposed to go up forever? They're the insiders. And here there is a rule. If the price is much higher than the value, insiders sell. If the price is much lower than the value, trust me, insiders are going to buy. And if you never see an insider buying, that's a bit of a poor sign, right? So keep this in mind, and, stable management, committed management that has real skin in the game, it's incredibly important. A management that has a vision for the medium and long term of a company, not just the short term to maximize shareholder value and this kind of crap. The only thing that they're maximizing is their stock options. Needs a very long term vision. Okay. Rule number 4, and here is where things become interesting, is fighting the hidden skeletons. Okay. So everyone has hidden skeletons. Okay. It's not necessarily a bad thing. Maybe something you just don't want to be known out there, something you're ashamed of, or something you simply just want to keep private or whatever. Okay. There's not necessarily a bad thing, right? But, knowing what are the hidden skeletons is very important. Okay. This is the rule number 4. And there are no shortcuts here. You need to do due diligence. You need to read through the document and read, freaking 300 pages of financial statements from top to bottom. Or, as I learned to do during my experience a very long time ago into equity research as a junior, actually start reading from the bottom to the top. Why? Because if someone has something to hide, we'll always do it at the very bottom when people are tired and maybe they don't want to read till there, all full of legal disclaimer, incredible, complicated language and all this sort of stuff. You need to put the work into this. I know the easy thing is just look at the chart or just do what everyone else is doing. That's not value investing. That's maybe trading, maybe, okay? But you really need to go to an extent to dig everything that could be dug out and make sure that you didn't miss any corner, okay? And here it comes the end, rule number 5, the very, very simple rule, value versus price. After applying all these rules and concepts techniques, ratio from intelligent investors, valuation methods, multiples and so on, putting your own consideration, discounts, projections, and whatever, you will come down to a value, okay? Here the rule is simple. If the price is way below the value that you assign to this business after coming down to an objective valuation is much lower than that, then it's a good investment. If it is higher or much higher, then even if everyone else is buying, fear of missing out and whatever, earning grows and stuff like that, I'm sorry, that's a no. If you're a real investor, if you're a real value investor, that's a pass. That's it. There's no other way to try to smoothen things out to justify an investment. If the price doesn't make sense, the investment doesn't make sense. Everything else is just narrative. Okay, everyone. So here is the hand. Considering the topic, please feel free to ask questions in the comment. You can go to JustDario.com forum to ask questions where I can answer directly or to share with our community. As always, thanks a lot for your support, for subscribing to the channel, for following me on social media, on Twitter X, on Instagram. and for really giving me all this strength to continue, like, carry on with this passion, honestly, that, it's quite fulfilling, because without your support, I would be speaking into the wind every week, right? So I wish everyone a nice weekend, enjoy, and talk